Welcome, everyone, to NAAIM Confidential Live.
Hi, I'm Kenton Kilmer, and today on Name Confidential Live, I'm joined by Grant Morris of McElhenny, Sheffield, and RIA based in Dallas, managing over $600 million in client assets. Grant oversees the firm's rules-based tactical strategies, including the trend-following Trend X strategy available on Adigence, and the TPSR blended trend/sector rotation strategy available under the ticker MSMR. Grant is a thoughtful practitioner of systematic investing, known for balancing robust quantitative models with a deep understanding of the behavioral and operational realities of portfolio management. Today, we'll explore what makes his strategies work across market regimes and what active managers can learn from his disciplined approach. Grant, great to have you.
Yeah, thanks, Kitten. Happy to be here.
Let's kick it off. Tell us a little bit more about McElhenny Sheffield.
Sure. Yeah, McElhenny Sheffield, RIA based in Dallas. Been around for going on 25 years now. 600 million under management, a little north of that at this point. And we manage for individual direct clients. We also do a lot of sub-advisory work for other firms, and then launched our ETF that you referenced in the intro in November of 21. So a little over 3 years on that product. And our focus is tactical money management. Obviously, it's something that the name community is probably pretty familiar with, but really everything that we do is set in these tactical ETF strategies that we have. One's trend following, one's momentum. We have a blend of the two. We have an aggressive trend following strategy, which we call Trend X, and then the ETF.
Well, I guess why don't we jump into some of the technical strategies, the tactical strategies that you're employing?
Sure. I will share some slides that we can talk through, some of which I probably already covered. So intro slide about the firm, the different strategies, trend, momentum, the blend, TPSR, and then the MSMR ETF, which follows the same approach as the blended model. So just kind of getting into a little of the details, trend following, and I'm going to stick mostly to the trend strategies today. Sector rotation could be, on another call, or if people are interested in it, we can talk offline. But the trend strategies, our view is U.S. equity markets trend over long periods of time. They're punctuated with, sideways choppy markets and down markets, but we can use a trend following approach on U.S. equities to manage risk and hopefully participate nicely in the upside. So that is the focus of these strategies. Trend X uses leverage, so it's more aggressive growth, but these are true risk on, risk off type approaches where we have equity exposure at times. And if there is not a trend in place based on our trend indicators and our model, then we're happy to sit defensive and not have any equity exposure whatsoever. So really fully tactical. Features of this tactical approach, generally we can provide lower drawdowns. That's one of the benefits of trend following or doing tactical money management. It's really focused on avoiding material losses, which is what clients have a hard time dealing with, I think, as we all know. And so, generally over a buy and hold strategy during the tough down markets, we're going to exhibit lower drawdowns. We often have low, if not negative, correlations during those tough periods. And so by not having any equity exposure during the more significant pullbacks and often being positioned in defensive asset classes that can appreciate while the market selling occurs, we might have positive returns when everything else is down. And so that drives that negative correlation, which ultimately just means that it's maximum diversification when it matters the most, right? And that's a really important point. And then real-time portfolio adjustments. This is more along the lines of, we're managing money for direct clients. And so if the market is selling off, a lot of times they get nervous and they call. And usually there's certain levels where I know the volume of calls from clients are going to pick up. And it's just nice to be able to answer the phone. And if they're worried about their portfolio or they're worried about what the market's doing, we can inform them we've already taken some risk off the table, or we've already fully de-risked because the strategies, got us out, stopped us out a week ago. And so everything that's happening right now, we're protected from. And so it really just helps with the behavioral aspect of managing money for clients and other advisors, because advisors have those same sort of behavioral issues.
So Grant, just I want to ask about let's define trend for a moment here. I think it's a word that's easy to understand sort of just by its definition, but what does it mean for you?
Yeah, so I mean, at a very high level, it means prices today are higher than prices of some period in the past, right? So if you want to define an uptrend, you can look at short term, intermediate term, long term. It all kind of depends on what style of trend following strategy you want to deploy, how you want to manage, what type of market moves you want to be involved in. But for us, we're really focused on kind of intermediate term trends. We're not we're not trying to day trade. 3 up days in a row does not constitute an uptrend in our book. And so we usually need to see, before we'll even add any equity exposure whatsoever, the market will generally need to be in an uptrend, moving higher. Obviously, it's not going to just be every day up. There's going to be up and down days, but generally moving, in a positive direction over a few weeks before we'll start to allocate. And then at that point, once you're in, it's more of let your winners, run, and if the market reverses course, then cut losses quickly.
In our preparation, I think, Grant, you really painted a very sort of elegant picture about how you look at a wide range, quite a large number of these indicators, across price-based indicators, market breadth indicators, and enabling a model that creates that it's the set of binaries. And then through that set of binaries, it gives you this conviction in the weight of the evidence in order to, trust the model, trust the way that you're able to have it implemented. Could you kind of shed a little bit of light about what some of those indicators are?
Yeah, and so, just like you said, and I threw the slide up on the screen, so multiple indicators and multiple time frames that are driving the underlying model. We think that each of the indicators has some level of importance, and it is our weighting scheme and kind of how we synthesize the reading from all the different indicators that then drives the portfolio management rules on when to get allocated. But price, I think most people are very familiar with price-based indicators. You can look at moving average crossovers, MACD. I mean, there's all sorts of ones out there, but an example, short-term price indicator could be a 5-day and 20-day moving average crossover, whereas a long-term could be a 50-day and a 200-day. The moving average crossover that Buffett talks about. Nothing good happens below the 200-day moving average, and sometimes he's talking about 50-day and 200-day. And so, you can take each of those indicators, and most technical indicators, if they're looking for a trend, or some people would use swing indicators looking for overbought or oversold conditions, and it's either, it's a binary reading. If the trend is in place, if that indicator shows that the trend is in place, the reading is on, and if not, then it's an off. Off doesn't mean it's a downtrend. It just means whatever that specific indicator is measuring does not signify that an uptrend is in place. Breadth indicators, a lot of people on the call are probably familiar with that, but public at large, maybe not quite as much. Breadth is really looking at market internals, right? So you're looking at new highs versus new lows, up volume versus down volume, advances versus declines. So getting under the hood of where the major averages or the indices are going. Lots of times you'll have the S&P 500 in a continual uptrend, but fewer and fewer stocks are participating in that uptrend, and you kind of miss it unless you look at breadth and what's happening under the hood. And then relative strength, for us, it's really a way to assess kind of the speculative nature in markets. And so we're looking at how small cap trades to large cap, how growth trades to value, because good persistent uptrends are often driven. You want to see speculative behavior from investors to help continue to push the market higher.
One thing I think you guys do really well is you're able to take something from a wide variety of data sources. You're able to digest those data sources in a way that creates not only actionable, but it's I think your implementation is just very you're really just able to have this risk on, risk off rotation from a couple of these leverage exposure products. I mean, how has that changed over time, or has it changed over time, where in which, hey, you've been able to kind of have this wide variety of signals and indicators, but have its output and its implementation in your security selection be something so I would say it's a relatively small universe.
Yeah, it's the model obviously has some complexity to it, and there's a lot of thoughtful, work that went into it, and it is a very distinct process that we can follow. But the implementation, as you say, is really kind of simple. So when we see an uptrend in place, we just want exposure to the stock market. That's it. That's all we're trying to do. And so we're not getting too cute with specific sector or industry selection or individual stocks. We just want cheap beta. And so we can buy index-based ETFs that are going to track the overall market. And so really with just a couple positions, we can get the exposure that we desire. The beauty of it also is that we're only using really liquid high volume ETFs in our holdings. And so it allows for, the opportunity to scale. We never have a problem placing a trade if we go from allocated positions to risk off. We can trade out of all our positions, without really any concern of execution risk or slippage or anything like that.
Yeah, there's certainly a lot of humility that comes along with you just trying to find cheap beta. But I know in this next slide, when we're looking at the implementation through the COVID bear market, I mean, please, we'd love to learn a little bit more about how you're able to pick up this beta opportunities tactically.
Yeah, so I think everybody wants to achieve alpha. That's kind of the name of the game, unless you're just a passive index investor, and then what you get is beta. And so for us, our alpha is really, really derived from having beta exposure at certain times, right? That's really what trend following is doing. So this is a chart. We like to show these to clients and advisors. It's kind of a good illustration, but it just really clearly shows what we're doing. And not in the weeds detail of how the model works, but you can look at enough of these and get a sense for, I think the MSCM trend strategies are likely going to be invested here and get out here, so on and so forth. Of course, the key is not knowing what the market's going to look like in the future. And so, looking at these in hindsight, it's kind of obvious what we did. But 2020, notable year. Well, I guess let me back up. So this is a plot of the NASDAQ composite. So if you pull up, stock charts or Y charts or anything and just plot the NASDAQ composite, this is what it looks like. And we have it shaded green when we had equity exposure, when the model called for equity exposure, and red when we were fully defensive. So red is no equity exposure whatsoever. It's not that we, dialed it back. It's that we were fully defensive, had no equity exposure. And the trend strategies typically were in US Treasuries and gold. And so depending how those are doing on defense, it might be positive trade or negative trade. But this year was interesting. We didn't know how big the pullback related to COVID was going to be. Nobody knew that. But when the market rolled over, we ultimately hit stop levels. We got out. We were defensive through the bulk of the downturn, actually had positive returns in February, positive returns in March, positive returns in April, because there was that flight to safety trade as people were panic selling out of the market. So treasuries rallied, gold rallied, and so that allowed us to kind of have positive returns and really no drawdown whatsoever during that period. And then, early April, the model picked up on that bounce off of the bottom. And again, it takes a little bit of time before we're going to buy in, and we have different indicators. Short-term price indicators might be the first thing that turn on. Eventually the model reading becomes strong enough that says, okay, well, this is an uptrend that we want to participate in. And so we start to add exposure. I will say that we go binary on the way out, meaning full risk on to risk off. But on the way in, we do step in and we adjust our stops. That way, value at risk, we don't put a ton of value at risk until we really have good confidence in the uptrend. But the key here is really, sell discipline is critical. but knowing when to buy and being able to place that buy order is maybe as important. I think sell discipline is probably the more important aspect. But on April 8th, this was a time where everything was shut down, and it felt pretty uncomfortable to be allocating into risk assets on April 8th. People thought if they walked outside and took a deep breath, they were still going to catch COVID and die, right? So a tough time to allocate capital, but we have a ton of discipline, and really, we're hired by people to follow our model, and that's what we do without question. And so April 8th comes around, we place the first buy order. Ended up being a wonderful trade, nice strong uptrend, all sorts of reasons on why that uptrend occurred. None of that really matters to us. We want to react to what the market's actually doing, the financial stimulus, the quantitative easing, all the different things that might have driven that rally. We're not trying to forecast those things or trying to figure those out ahead of time. We are just simply reacting to what the market's doing. It's in an uptrend, so we're going to participate. And then you see, of course, a few trades towards the end, after August. There was a few in and outs, and every tactical strategy, most quantitative strategies, they're going to have whipsaw periods, and that's just part of managing money this way. So end of the year, Trend Plus was up, over 35% net of fees, and Trend X up over 100. And I will say Trend X is our hedge fund strategy, so it has a 2 and 20 fee structure, so it's pretty significant returns that year.
And let's take a look at another example where in which you were coming in and out of the market. What I liked about this chart, even though chronologically we're going backwards from 2020 to 2018, one thing that I think that highlights really well, following the same presentation methodology of green, you're in, right? Your equity exposure. Red, you're out, and having defensive exposure. This really does a good job, and I'm kind of just taking your thunder here because I found this to be really impressive. Being able to identify three separate regimes, three separate markets happening within a single year period, and how your model was able to be dynamic to continue to capture upside while also alleviate and avoid the downside during a choppy market like this.
Yeah, that's exactly right. I mean, each calendar year is likely to see a couple of the different market goes up, down, or sideways, right, at a high level. And so trend following works really well when the market is trending, and that can be an uptrend, which is preferable because then we're all making money, or a downtrend. So a major correction or a bear market, trend following usually handles those very well. Maybe not getting positive returns, but relative performance is usually pretty good because we're reducing drawdown. But the time periods that are very tough for trend following, and any of the practitioners out there that have run trend following strategies, they'll know that the sideways choppy markets and the whipsaw periods, which you see here in the yellow box, kind of, January was still uptrend, but then once the end of January hit, it was a lot of volatility, a lot of big swings in the NASDAQ and the S&P and kind of all the major averages. This was that Volmageddon period where some of the big space funds actually blew up and kind of went under. And so, multiple whipsaw trades in a row, if you have stop losses that are, 3%, 6% different ranges, and you have cumulative trades at max loss, then overall you're gonna, be facing a low compounded return, negative compounded return. And so during this period, Trend Plus was down about 15%, Trend X was down about 39 or 40%. So fairly significant drawdown. But what we know from a lot of studying charts, studying history, the market does not stay in that environment or that regime for too long. Maybe a couple quarters. Very, very rare for it to have 4 quarters in a row of just sideways range-bound market. Eventually, we always say the market's got to pick a direction. In this year, it happened to go up and slow, steady, uptrending, lower vol mode. And so we had some positive trades, which were good and helped kind of recover the losses from earlier in the year. And then most people will remember fourth quarter 2018, where right after October started, the market just started to sell off. And it felt like every day was down. I mean, there were some little counter trend rallies, but for the most part, it was pretty significant sell off. Not quite a bear market based on the 20% in the S&P definition, I think S&P was down 19.78% peak to trough, bottoming on Christmas Eve, December 24th, and then rallied a little bit. But our strategy stayed defensive during that whole time. We had pretty tight stops going into the beginning of October. And so we gave up very little from that last trade before we got defensive. And then again, the flight to safety trade occurred as the selling kind of accentuated. And so gold and treasuries rallied. We were able to, in the trend plus strategy, we were able to have a small positive return for the quarter when the S&P was down maybe 15% for the quarter.
And how about looking into the future? Anything in your crystal ball?
Yeah, we don't. I'm going to flip to the 2025 just to show, year to date. But this, of course, is still the past, right? It's not the future, and we really don't. This may sound strange to some, but we really don't spend any time thinking about the future. We don't do forecasts. We don't do predictions. We really just react in a very disciplined, quantitative approach to what the market is doing each and every day. And so there's a lot of people that spend all of their time thinking of macroeconomic variables or what policy changes, how that's going to affect the market. And they try to, make forecasts and make guesses about all of that. And then, even if they get those guesses right, which most don't, at least not consistently or in a reliable way, they still then have to make an additional guess about what the market is going to do in response to whatever variable it is that they're trying to predict. And so we just don't think that's a very sound approach. I know it's a popular thing to do, and we like to chat about macro events and what the market could do and what the environment looks like. But at the end of the day, it doesn't go into our money management decisions. We follow our model. Our model's assessing the market every day. And as far as this year, which has been an interesting year, market was range bound. This is again the NASDAQ. So NASDAQ was between 19 and 20,000 for several months, even going back into 2024, last couple of months, and then through most of February. We had some whipsaw trades. The market starts to sell off, we get out, it goes back up, we get back in. And the key here is we don't want to stay wrong for long. And so we're always going to change our position based on what the market's doing. But thankfully, in the trend strategies, February 26th, we got a sell signal, hit our stop loss levels. And so we got defensive, and because gold and treasuries rallied in March and April, we had positive returns these months. And so we actually didn't have any drawdown. And then market environment seems to have changed. I don't know if it has. It could go back down tomorrow or next week, but generally the model picks up on the bounce off of the bottom and a little bit of an uptrend in place. And so, since late April, I forget exactly what date we placed the trades, but added some exposure in April, added more exposure in early May. And so far, nice year-to-date returns, especially compared to benchmarks.
So there's something that's refreshing when we look at an example like this, and you touched upon it, but you've got a fully systematic approach, but you've also built it with, I think, kind of think about this as like a behavioral realism in your mind.
Yeah.
And so when you think about the application of a systematic model within your expertise, within your experience in terms of what is actionable, how do you sort of define, or how do you balance what seems to be behaviorally sustainable in your implementation of models?
Yeah, I think that's a really, really important aspect that most people ignore. A lot of the technicians, a lot of the people that are trying to develop quantitative trading strategies, they're just trying to find some optimal signal to act on. And so maybe they find an indicator that has pretty good results in a time period, and so they're like, okay, well, this is what we're basing our model on, and then they start using that. And there's all sorts of problems with data mining and overfitting,
right.
And building this beautiful back test, and then all of a sudden you start live trading and it doesn't work as well. But from the behavioral standpoint, even if you have a good system in place, the key in my mind is really making sure that the model fits your personality as the manager and what you can handle as the manager. So a lot of our approach involved really thinking about, if I'm running this model for clients that are, paying me to manage their money to this model, I have to be able to place 100% of the trades. I have to buy every time it says buy. I have to sell every time it says sell. And not only do I need to manage my ability and my emotions, right? The human behavior, the fear and greed that's in all of us, have to manage that. I also have to know that I need something that my clients can handle also, right? So depending on what model you're trying to implement, and some people have really fast models with tight stops and early entry points, and inevitably that means you have more whipsaw trades, or a slower model will have less whipsaw trades. But there's pros and cons to every variation, and a lot of it is, what can you have that you can stick with and that you can help your clients stick with, because if those two things aren't there's not really any point of the model, right? Unless you're just running it on your own account and it's not part of, managing money for other people. And so that's really something. Obviously, I learned a lot from my dad, Greg Morris, as far as this approach, and I think a lot of the NAIM members are familiar with him. But that is really, one of the keys to us being able to implement these strategies across, our large and growing amount of assets.
Do you think it's oversimplification? I think you were talking about fitting of models and sort of looking for evidence that supports your worldview and may or may not be right as being a pitfall that, technical and tactical asset managers can find. And I think about this quadrant of, well, you can be right for the right reasons, right? And you can be wrong for the wrong reasons, and then, right for the wrong reasons and wrong for the right reasons. And the oversimplification here is like you guys are sort of taking that whole thing and saying, we're not even gonna play that quadrant game of am I right for the right reasons? It's just, what's the model telling me? And is the model telling me with enough conviction to know, am I right for my next holding period?
Yeah, and I mean, not to think that our model gets everything right, right? I mean, any whipsaw trade, that's because the model told us to do something. We executed a trade one way or the other, and it's a whipsaw trade because it didn't work out the way we had hoped, right? So the underlying kind of phenomenon of trend following is that the markets do trend. There's a lot of herding behavior and fear of missing out that drives trends higher. And our view it is really that once a trend is set in place, it's very likely to continue. It doesn't always continue, but we know that there's enough good uptrends that if we have a system to get in place and add exposure during some of the uptrends, and then, like I said earlier, kind of just let the winners run, then then that can be an approach that we're happy with. Obviously, there's always has to be some amount of testing and back testing and kind of seeing what historical results will look like. But I think people get too sort of enamored with just running indicators and seeing what kind of historical profits it could have generated without taking into account the human aspect of it, which is whether they could have placed all those trades. Because I tell you, if you have a system that does really great in many, many years and then hits a period where it has 10 or 15 whipsaw trades in a row, most people throw it in the garbage bin and go look for something else, right? And so that's really key of creating a system that fits with you as a manager.
Yeah, it makes me think of hedge fund hotels that will, dial up and dial down different strategies if they're doing well, and if they're not doing well for a period of time.
Sure, yeah, yank them, pull their money, allocate to another manager.
Right.
And they're kind of doing it with the PE model where they're trying to get, one out of 100 or one out of 1,000 to really, really pay off. And that's fine. But most managers, I think a lot of managers are just trying things that they thought worked in the past, and they get lucky. Maybe we're getting lucky sometimes. I'm sure we are.
Of our PE friends, I think you're describing more VC of the spray and pray.
You're right. Yeah, sorry, not PE really, but yeah, more the VC, the startup
God
investment.
forbid we have people underwriting for leverage buyouts here, it's
Yeah. No, thank you. Important distinction.
but and then as a little bit of a pivot here, I we what I think again is really refreshing about what we're talking about here and you can run with this question however you want it, but I really want to, there's a lot of excitement, and to a certain extent, there's noise as well around AI and asset management.
Mhm.
And given your behavioral approach, right, being able to know oneself and have conviction within the signals, all else being equal, where do you see the human element remaining in this type of strategy, and especially in implementing such rules-based strategies?
Yeah, I think there are likely to be some good AI models, and whether they're AI models assisting humans in making investment decisions or more, black box type systems where humans may not really know exactly what's going on under the hood. Like, it's very likely that there's going to be some of that out there that can perform well. I don't see it as a replacement, but it's maybe, another step towards diversification, or another, way to allocate something different that the rest of the managers, the rest of the world's not really doing. The part that I see being difficult is that, there's no silver bullet strategy. There's no strategy that's going to have a positive trade every time. There's no strategy that's going to have, positive months every month, regardless of market environment. I just don't think AI is going to ever deliver something like that, nor is any, other manager. And so the I think a big piece is going to be when it has underperformance. Let's say there's an AI model that does really great, but when it starts to underperform, and maybe it has a lot of whipsaw trades, or maybe it just generates cumulative losses for a period of time. Maybe it's a few days, maybe it's months. I don't, it's all hypothetical at this point. But without a deep understanding of what the model is, what the investor is trying to accomplish, or what the manager is trying to accomplish, how they're expected to generate alpha, I think people will abandon those pretty quick. You might have a small allocation to something, and regardless of how bad it does at times, if it's got some positive expected returns, maybe you'll keep it. But I don't think the bulk of assets will ever go towards an AI model, because I don't think humans probably ever trust it during the tough times. And kind of, my clients find it very comforting to call me and talk to me about not only what the market's doing, but what my model's doing. And if it's just an AI system, maybe that's not, they're not going to get to that comfort level.
Yeah, that's a hot take, and I will reserve. I definitely am very much in whipsaw between AI maximalists and where it's a tool and where it's an opportunity. But I think that what really resonates with me is the ability to articulate what you're doing. And so ultimately, strategies that are inarticulate when things are not going well, how are you supposed to gather assets around that? How are
Right.
you supposed to
Sure.
create comfort around that? Because, being articulate for when things go well, you're making the assumptions that you're right for the right reasons.
Mhm.
Things are not going well, and you can kind of just point at a black box. You really don't create a lot of comfort between, are we wrong for the wrong reasons or wrong for the right reasons, and looking at the wrong things. So there's something that I think is very underappreciated in the way that you're implementing this this behavioral discipline in something that's purely quantitative. But anyway, I'll let you continue to go on. I know we have a couple slides about your performance of these couple of strategies.
Yeah, so I'll just throw up a few slides. We have fact sheets posted to our website, so anybody can go to our homepage and click strategies and look at the results. But just a few highlights. Trend Plus is the main trend following strategy that does not use leverage. Pretty strong returns. We consider a 60/40 portfolio to be the benchmark, because we're never taking risk. We've gone through all the risk analysis and Stratify and Riskalyze and all these tools out there. And so they all measure us on the risk side as being less risky than a 60/40, actually closer to probably a 50/50. So it's a pretty conservative portfolio on the risk side. But then return side, we're generally doing better. And we think if the S&P goes into a major bear market, we're likely to be outperforming 100% equity allocation. But we need those big events to happen. Otherwise, tactical is not not that useful of a strategy, right? We're pretty sure that those big events will continue to happen, whether a 25 pullback bear market or a 55 like we saw during the financial crisis. But solid returns, good risk adjusted returns. Annualized volatility is not my preferred measure of risk, but most academic finance pays attention to that. We think drawdown is really the most important measure of risk, because that's what the investors see when their account balance goes from $1 million to 800,000. 20% drawdown, 200K of lost dollars. And so that is what is impactful to them. And so we really like to have a process in place that helps minimize drawdowns. And then also I mentioned earlier about the negative or the inverse correlation during bear markets. And that's really, we have it in this table here, but we break up the market into bear market days, bull market days, and we track correlations of our strategies and look at all that. And the trend strategies, because they have no equity exposure and they get out of the market pretty quick, the defensive positions, they don't always pay off, but a lot of times they do. And so over long periods of time, it actually drives inverse correlation. So a much better diversifier to your typical portfolios than a lot of the other things. People say they want uncorrelated return streams. I think that's not correct or not thoughtful. You really want max correlation during good, strong up moves, and you want negative correlation during bear markets or down moves, right?
Yeah, that's well said.
Yeah, uncorrelated returns means maybe it's not delivering any return at all, and it can be uncorrelated. So you want returns, and so it's nice to have good, positive, strong correlations during up markets, and if you can, inverse is great. Not always achievable, but it's nice when it happens. Trend X is the aggressive strategy that uses leverage. Very similar implementation to Trend Plus, but we're going into levered ETFs to get the exposure. Obviously, annualized volatility is going to be much higher because that leverage adds vol. But for our strategy, we feel we're pretty good at capturing upside vol and not being exposed to all the downside. So again, annualized volatility is not that useful for us. Max drawdown, of course, is also going to be larger with the leverage, because if you have certain stop levels and then you have a 3x levered, NASDAQ 100 position as an example, you're gonna take a much larger loss, and multiple whipsaw trades can result in that. Down 39%, not an easy strategy, not an easy time period to withstand. But if you know up front to expect that level of volatility and that kind of swings, then it's been a powerful strategy for the clients that are using it. And we do run it as an SMA, and so qualified accounts have been able to allocate to this, and so it's been a really great performer.
Yeah, this has been something that has been a highlight for us on the Adagens marketplace, being able to show some very strong returns, especially through the beginning of this year. So yeah, break a leg out there with this guy.
Yeah, absolutely. I think it's slowly getting real attention, which is nice. But it takes time to build a track record, and these all started in 2017. We're GIPS compliant on everything, so got a good amount of AUM behind us now, and good solid track record. So that's helpful. That draws attention. TPSR, as you referenced it, I think in the intro, but we have it's just Trend Plus and sector rotation. So Trend Plus being our main trend following model, sector rotation being our momentum model. And this is the separate account strategy that we actually used to deploy the ETF in November 2021. And so, good risk adjusted returns. The beauty of having two distinct tactical strategies blended is that they help each other, right? They're not correlated perfectly. They're following different, trying to take advantage of kind of different market factors and a different set of rules, different set of indicators. And so they really help smooth the ride. And when Trend Plus is getting beat up with whipsaw trade, sector rotation is usually doing just fine, and vice versa. Trend will get out a lot quicker on pullbacks and get in a lot quicker on market bounces. Sector rotation is a slower model by design. That helps them work really well together.
And let's end it with my favorite slide. This is awesome, Grant. Walk us through what's happening here.
Yeah, so this is hat tip to Aptus Capital Advisors that kind of did the first view of this. They're the team that we partnered with to launch our ETF. They're the advisor on the ETF. We're the sub-advisor. But this is looking at the separate account strategy, Trend Plus, and just taking taken the since inception, the worst monthly returns for the S&P 500. So March of 2020 was the lowest one. The S&P was down more than 12% during the month. And then just putting next to it with the dark blue bar, how Trend Plus, the main trend following strategy, performed in each of these big down months. And so, other than May of 19, which was still less than 4% down, we have a lot of months where we're up when the market's down, or if we're just down slightly. And so this is really the heart of the risk management that we're trying to provide. If you have index-based portfolio, you can of course add bonds to it and have a stock bond portfolio, but really the next step for diversification is adding something like tactical and trend following to really help offset the periods that the static allocations are getting beat up, right?
Yeah, and just so I'm hammering this home, so the teal lines, right, the green lines here are the performance of the worst 10 months performance for the S&P 500 if you were just broadly exposed to that index. And that
Correct.
not only have you been able to outperform and generate performance during these big market pullbacks like we've seen in a few of these examples, but even on that worst month, what we were showing here in May 19th, just to use my annotation function, even in this scenario, being able to weather this loss here, and then being able to roll forward with your clients at that time. I mean, really,
Yeah, it goes to the heart of why use tactical. It's really the math of compounded returns. If you can decrease the negative numbers in your compounded return stream, you don't have to have as large positive numbers to still stay ahead, or to keep up. And so we really are happy when we have months. It's sometimes not always going to be relative performance, or excuse me, absolute performance. Sometimes it's merely relative. But if we have relative outperformance in the down months, and then it's likely we're going to underperform in really strong bull markets, because there's times that we're going to be defensive, and in hindsight it'll be unnecessary. But really decreasing the large negative numbers over time can just help us generate higher returns.
all right, Grant, you've been incredibly generous with your time on a Friday afternoon. I think, yeah, any last words of wisdom you can sign us off with?
No, I mean, I think we covered everything. Great conversation. Thank you for having me on. Always happy to talk about these things. I'll just throw this up so people can see how to contact us. I prefer email over phone calls, but our website's there. If anybody wants to go there and look at the strategies and reach out to me, happy to talk about this stuff with anyone.
Hey, that's great, Grant. Thank you so much. And I
Okay.
would be remiss to not mention we have an upcoming conference coming up in Chicago. You can circle on your calendar. That is November 3rd and 4th. And we still have early bird pricing up until August. And so looking forward to seeing everybody out there. Have a great weekend.